I'm here for a reason, and it is an interesting story. I want to share with you the science behind successful investing. Yes, you got that right. It is a science. It is a methodical approach that has its own rules, codes, edicts, and principles. If you follow those correctly, consistently, and strictly, as do the top 1,327 most successful traders of all time, you too will become extremely successful and wealthy thanks to your investments. Here is the complete investment guide for newbies and veterans alike. In this vademecum, I will show you exactly what to trade, where to invest, when to take it easy and stay put, whom to trust, and how to make real money. Stay tuned. Welcome back, folks, to another edition of Sweetie Kiwi. I am doing fantastic today. I hope you are doing fantastic today. Are you doing fantastic, marvelous, awesome, superb? If you are, grab a cup of coffee or tea or vodka and let's roll. Now, today I want to talk to you about, things that you need to do to clinch success and wealth ASAP. And we are in this wonderful show, and I'm going to share with you a lot of tips and tricks to really learn how to trade, what to trade, when to trade, and how to make real money for real. Now, before I start, I just want to quickly give a shout out to our millions of viewers and listeners and fans in the United States and Canada and beyond, and in the whole world. Particularly, I want to give a shout out to Danny Puckett, Alamosa, Colorado. Thank you, Danny. Another shout out to Billy Cruz, Plattner, Colorado. Thank you, Billy. And Celia Hurley in Red Cliff, Colorado. Thank you, Celia. Celia, Billy, and Danny. We appreciate your help. Now, let's just jump into it. This is going to be an easy peasy investment guide. So I'm going to reduce the technical jargon and really, use as layman terminology as possible. What do you have to trade? First thing, factors to consider in selective financial instruments, right? The idea here is to have a portfolio that is very easy to monitor, very easy to constitute, and very easy to change over time, to adjust over time. So what do you need to trade? Now, before you think about trading some financial instruments, and I will talk about what financial instruments mean, you have to think about something called volatility. First of all, let's talk about liquidity. Now, what is liquidity? Liquidity refers to the ease of buying and selling a financial instrument at any given time. Now, liquidity is very important because if you buy, let's say you have a financial instruments that you have realized a profit on, you have accumulated profit on, and you're trying to sell it, if the instrument is not liquid, you are on your own. You might be sitting on that profit, but until you sell it, you will not realize the profit. You will not get the money, the cash flow into your bank account. So it is very important when buying financial instruments to target those instruments that are liquid. Liquid is the financial term to explain that an instrument has a lot of buyers and sellers, has a lot of movements, right? So instruments with high levels of liquidity tend to be easy to trade, as one can enter and exit a position with ease. Let me give you an example. Let's say that you bought let's say you bought a stock, a company stock, right? Any company stock. You bought the stock, one share for $100, right? After 1 year, the stock is now at $200, right? You have a profit, a book profit of $100, right? Now you're trying to sell that share, and nobody is willing to buy it. What will happen is that illiquid instrument will just sit in your book. You have a profit, but you can't actually realize that profit. So that's what liquidity stands for. Number two, volatility. Now, volatility refers to the ability of a financial instrument to rise and fall sharply. Now, what that means that some instruments, for instance, some IT instruments, are very volatile. So when people talk about volatile, it means that the instruments can actually, rise very, very fast or fall very fast. For instance, a company, the shares of a company like Google, for instance, Google is highly traded on the stock market, and it is a stock that has the ability to be volatile. In other words, it can rise and fall very sharply. Now, there are things that impact volatility, and there are things that suppress volatility. But the bottom line here is that, before you trade something, factors to consider before you select financial instruments. You have to ask yourself, are you comfortable with a low volatility product or a high volatility product? This is very important, not only for your short-term risk profile, your short-term risk analysis, but also your long-term. And the long-term risk analysis is more important for people who have a retirement sort of perspective. If you are investing with a retirement vision, you are not going to buy the same sort of products that you would if you are having a shorter-term vision. So volatility is a two-edged sword that can be a blessing and a curse at the same time, right? Because high volatility tends to work to the advantage of traders who know what they're doing. If you know what you're doing, then you can basically, embark on a highly volatile instruments, and you can generate multiple profit. You can generate profits multiple times, right? The drawback of volatility is that a small mistake in times of high volatility can cause you to have humongous losses, right? So, and you can have those losses very fast. My wise advice to you is to stay away, if you're a newbie, to stay away from highly volatile instruments, right? Of course, I was talking earlier about Google, but Google now being part of Alphabet, maybe a highly volatile stock, but it's still it's still a stable company that so you can still invest in the company and be comfortable that nothing will happen to your money. I was more thinking about those sort of highly illiquid instruments that are still also volatile. So one day the price goes to 100, the next day it goes to $2, and there's no liquidity in the market. That's when the risk lies, right? So volatility is another factor you have to consider when selecting financial instruments. The third thing you want to consider before selecting a financial instrument is the transaction cost, right? Now, a financial instrument with a low transaction cost is ideal, right? Because it allows you to generate optimum returns on any given trades, right? Now, various brokers charge different trading fees for different financial instruments, right? We'll see in the next section what financial instruments are, but some financial instruments are more expensive to trade than others, right? So the idea here is for you to shop around and find a brokerage company that allows you to trade at a very, very reasonable cost. Now, one thing that is also very important is that take advantage of technology. Right nowadays, we have apps, we have software, we have free or low cost software. We have apps that allow you to basically invest in markets directly. Now, in this program, I will refrain from using specific brands and companies because I think they're not paying me enough. They don't pay me, so I'm not really endorsing them here, doing free publicity. But the bottom line here is that if you have a lot of apps on Android or iOS that allow you to trade, and they have very low transaction costs. The fourth element you want to pay attention to when it comes to what to trade is the availability of information, right? The free flow of information is critical if you want to have a profitable career in trading while trading any given security. You want to have free flow of info. You can't be buying, instruments on which you have no info, or a company or a commodity or any instruments on which information is scarce, right? Because you make investment decisions based on the availability of information, right? Not only the availability of information, but also the continuity of that availability. So it's not information being available one time. You want to have a free and continuous flow of info. So, and the reason why you want to have information here is because news affects prices from time to time, right? So if you don't have information readily available on the financial instruments, you wouldn't be able to have a right investment strategy, and you might be actually ending up having losses because of lack of access to the right type of info. So let me recap the 4 factors to consider when selecting financial instruments are liquidity, volatility, low transaction cost, and availability of information. We'll be right back right after this. Welcome back, folks, to another section of Sweaty Kiwi. I'm glad that you are here with us. Now, I'm very happy to continue this conversation with you. And for those who just joined, we are having a free conversation, an open conversation around investment, right? This is investment. Of course, this is the investment guide for newbies and veterans alike. Now, for veterans, the definitions might be a little boring, but hang tight. We will get into the nitty-gritty very soon. I just need to lay the foundation of this show to explain to those who are newbies what we are talking about, so everybody's on the same page. So, what are the top financial instruments? Now, there is a host of financial instruments out there. Some are traded on open markets, and others are traded in closed market or private markets. Now, here, for the sake of the discussion, I'm going to focus only on 5 financial instruments, or 5 classes of financial instruments. Now, the first one is Forex. Now, Forex stands for foreign exchange market. Now, this is the largest market in the world in terms of liquidity, right? It also comes with some of the best financial instruments that you can trade on a daily basis. Now, the Forex market accounts for more than 4 trillion in average daily volume. That's what I said earlier, that it is the largest market in terms of liquidity. Now, foreign exchange is very simple. It's really the art of trading currencies by merely taking advantage of changes in the currency pair prices, right? So some of the most, so for instance, if you have the euro dollar, for instance, if the euro dollar, which means how many dollars it takes to get a euro, let's say, let's just break things down very basically here. Let's say, or the euro pound, the British pound. So you have 1 British pound equals, say, $1.2, right? And if this is the value today, and 1 year from now, the pound, the British pound, goes to 1.3 US dollar, there is a profit there because there is growth. So the British pound is becoming more valuable against the dollar. So if you take a position, if you buy the pound dollar currency pair, you would have made some profits. Now, I'm not going to go into things like things like pip, things like floor, things like resistance. No, I'm not getting to that right now, but I'm just trying to explain to you that when it comes to foreign exchange, you are taking advantage. You are simply taking advantage of changes in currency pair prices. Now, some of the most commonly traded Forex instruments include pairs of the biggest economies in the world, right? So you have the United States, Britain, Europe, Japan, and this is why you have pairs like the euro dollar, the pound, the British pound dollar, the US dollar versus the Japanese yen, and the US dollar versus the Swiss franc, right? So those are the 4 they're called majors in the Forex market. Now, financial instruments number 2, stock indices. Now, stock indices are not equities, right? So The stock indices actually they highlight the performance of a broader stock market, or sometimes a portion of the market, right? So what they do is that the indices they list stocks of companies from a given sector or based on their market cap. Now, market cap stands for market capitalization. Now, the prices of selected stocks usually are weighted as a way of making it easy for global investors to to compare their returns on specific investments. So a stock index, for instance, could represent the performance country's economy, or the country's stock market, or it could be the whole world stock market. So for instance, S&P 500 is one of the best financial instruments under the stock indices category. It's one of the best known, if you will. A lot of institutions trade it, a lot of individuals trade that stock index, and it's very big. And this is it really tracks the broader U.S. market, right? Because S&P 500 is telling you they have 500 companies. It includes up to 500 companies, right? So it is really a good indicator of the movement of the broader U.S. stock market. Now, in contrast, if you take another index, the Dow Jones 30, right? The Dow Jones Industrial Average, that is a very highly traded in the index, but it consists only of the stocks of the 30 of the largest companies in the U.S. So this is an index that is weighted index, right? What this means is that larger companies account for more in the calculation of the index ratings. So this is why it really sort of fluctuates. So the fact that the index accounts for about a quarter of the value of the entire U.S. stock market makes it an ideal financial instrument. This is very important, right? Because by buying the Dow Jones Industrial Average 30, you are tracking the entire U.S. stock market, because you are actually getting 25% of the entire U.S. stock market. Now, one thing that is very important is that you can trade those stock indices very easily. Why? Because of what I spoke about earlier, because of high levels of liquidity and volatility. So if you buy them, you can sell them with ease. You don't have to wait until 1 year or 30 years or whatever before you can sell and make a profit, right? So I'm talking about the major ones, including S&P 500 and Dow Jones Industrial Average 30, the top 30. Now you also have other overseas. You also have other popular, I would say, stock indices. I'm talking about the Wilshire 5000, right? You also have the DAX, which is the German stock index. You also have the Japanese stock index called the Nikkei 225, and you have the Britain FTSE 100. So that's for stock indices. Now you can buy stock indices if you're not comfortable enough to buy the equity of an individual company, right? So instead of buying, for instance, the stock of Google or Amazon or JP Morgan or Caterpillar, for instance, you can buy the index of the sector. You can buy the index of the sector, or you can buy Dow Jones 500, Dow Jones 30, or S&P 500. So I'm just trying to give you here the top 5 financial instruments, the top 5 classes of financial instruments. The third one is equities. So in addition to stock indices, individual equities, what I just talking about earlier, are also possible financial instruments, right? So if you don't want to have greater exposure through indices, you can opt for individual stocks of companies, right? If you're not comfortable with how the overall economy is and you are very bullish. Being bullish means you're very positive about the prospect of a company. If you're bullish about, say, Apple or JP Morgan or Caterpillar or Federal Express or Huawei or Samsung, if you're bullish about that company, you can buy the stock of that particular company, right? So this is very important. and you by doing so you can profit if the stock price is rising, right? But you are also going to lose if the stock price is is declining, really. The fourth instrument here, the fourth financial instrument that is very important is commodities. Now, liquid commodities include things like crude oil, gold, and silver, right? And this is a good way for retail investors to trade on financial markets. Now, again, when I'm talking about liquid here, in the rest of this show, liquidity means, there is a humongous amount of buyers and sellers, right? So liquid commodities here include crude oil, gold, and silver. Now you can buy and sell commodities through futures contracts on exchanges, right? So there are several types of commodities, right? You have things like agricultural commodities. So you have livestock and meat commodities. You have energy, precious metals, and industrial metals. So under the metals category, you have things like gold, silver, platinum, and copper. Under energy, you have crude oil, which remains the most traded. You also have natural gas, and gasoline. Now, when it comes to livestock and meat category, you have things like pork bellies, lean hogs. In the agricultural sector, the most popular financial instruments are coffee, cocoa, rice, wheat, soybeans, and corn. So all of those things that you buy in the supermarket, things that go into your diet, those things are traded. And those things in financial parlance are called commodities. They are traded, meaning they are bought and sold. You can buy them and you can sell them. So in the United States, the most popular exchange for trading commodities is run by the CME Group, right? So that's the Chicago Mercantile Exchange Group, right? So in the commodities market, things work similarly. So in other words, forces of supply and demand will drive prices, right? So if you have lower supply, if the demand is higher than the supply, then the prices will go up, and if the demand is lower than the supply, prices will go down, right? This is just basic economics. Now, the fifth financial instrument class is something called exchange traded funds. So the exchange traded funds are investment funds that seek to track the performance of given sector indices, commodities, or bonds. They're usually called ETF. And what they do is they usually cover a broader range of assets that range from stocks, bonds, currency, real estate, and commodities. So you can buy that. And if you want to have, let's say, exposure to the larger market, you can buy an ETF. And what you do is you are trying to replicate the performance of a given underlying asset, right? And that kind of helps you because you are cutting on transaction cost. So instead of trading equities or indices, you can just buy ETFs as if you just trading because those ETFs trade. In other words, you can buy and sell them as you would you would regular stocks, right? So those are the really five. So you have exchange traded funds, commodities, equities, stock indices, and forex. Now, there are, as I said before, there are gazillion financial instruments. I'm only giving you the 5 that you need to really make money, to become a millionaire, to retire, relaxing, to go on vacation, to get a nice stand in Acapulco, to have a nice party, to enjoy life. You don't have to get into the nitty-gritty of sophisticated financial instruments, things like options, things like derivatives. No, you really don't need that. Now, maybe one thing I want to mention, which I didn't hear, is government treasuries. So government treasuries are part of what is called fixed income products. And government treasuries, the T-bills, U.S. Treasury bills, U.S. Treasury bonds, as well as corporate bonds, are part of the fixed income products. We have a show that you might want to check that show. We have a show that was dedicated specifically to fixed income products and also equity products. So I will really encourage you to check that show to have a better view of what those products are. I'll be right back right after this show, after this break. Don't go anywhere. Welcome back, folks, to another section of the Sweaty Kiwi Show. I'm very happy to have you here. In the previous section, we were talking about the types of instruments, the financial instruments. In this section, I want to talk to you about the specific type of financial instruments you have to trade, and what criteria you have to use to determine which ones apply to you. Before I get into that, I want to give a shout out to our millions of viewers and listeners and fans in the United Kingdom, in North America, in the United Kingdom, in South Africa, in Nigeria, in Brazil, in Singapore, in Japan, in Australia, and New Zealand. You guys are fantastic. You are marvelous. We appreciate the support. We appreciate the feedback. Thank you very much. And I also want to give a shout out specifically to Carson Lee in Torrington, Connecticut, in Mel Navarro in Kensington, Connecticut, and Brianna Morin, New London, Connecticut. You guys are fantastic. Brianna, Mel, and Carson. Thank you so much. God bless. God bless you and your family. Now, how do you choose the financial instruments you need to trade? There are several factors that you need to pay attention to. Number one, your risk profile. Are you risk averse or a risk taker, right? Risk aversion is just a way to say it to, in layman terms, you want to determine whether you are comfortable enough to lose money. That's what it means. Are you a risk taker or are you a risk averse person? So if you are a risk averse, it means that if you lose money, because in the financial industry, in the investment game, right? Because it is a game after all, right? Some people are better players. Some people are better gamers than others. In the investment game, it all boils down to, are you good at losing money and are you good at making money, right? And the bottom line at the end of the day is to lose less than, is to have fewer losses than victories, right? Fewer losses than win. So risk aversion is just a technical way that determines whether or not you are comfortable losing a lot of money. If you're not, then you're called risk averse. If you are, then you are called risk taker. So risk aversion is an important criterion that will determine which financial instruments to trade. Your age will also be another criterion here. It's an important parameter here in determining which kind of instruments to trade. Now, chances are, if you are in your 20s, you will be inclined to trade things like stocks, right? Highly volatile stocks. But if you are in your 60s or getting close to, in your 50s or getting close to retirement, chances are you might want to be focusing more on fixed income products, the less volatile products, because the goals, because the vision, because the requirements of a good life are different at each different stages in life, right? So someone who is in their 30s doesn't have the same requirements as someone who is in their 70s. So that's the age. Now, investment goals are also important. What do I mean by investment goals? Now, investment goals are very important in terms of the objective you have in the short run, but also in the long run. So if you want to say you want to preserve wealth, right? Sometimes you hear a lot of rich people, a lot of very wealthy families want to preserve wealth. So the idea here is not to make a significant amount of cash, a significant amount of profit, but the idea is to preserve the wealth that has already been accumulated. So because of that, they will be flocking to low risk fixed income products. But if your investment goal is to be a little aggressive, you're trying to double your portfolio balance every 5 years, then that's going to force you to engage in some other sort of investment tactics and tricks and tips. You would need to trade as if you were a hedge fund manager, right? So your situation in life is also important. Are you employed? Are you Are you comfortable in your own skin in terms of your choices? What is your social network? Do you hang out? Whom you hang out with? This sort of social, psychological, mental, and physiological constructs will also impact the kind of instrument you are, the financial instruments you have to trade. I will talk more. I will break it down further in the following sections of this show, how your situation in life, for example, will impact the instruments you are likely to trade. Whether, for instance, you would rather just trade commodities or trade equities or stock indices. These things will impact your situation in life, and vice versa. Your family status will also impact the kind of financial instruments you want to trade, right? If you are married with children, with the young children, you will be acting as if you are close to retirement, right? Because there are certain risks you can't take. Your risk aversion will go up. There is how do I call it? There is an inverse relationship between risk aversion and the situation in life in terms of having children or being married, that kind of stuff. So if you're married with children, your risk aversion will go down. If you're single, your risk aversion, your risk taking will go up. So, sorry, if you're married with children, your risk aversion will go up. In other words, you'll be more risk averse. So you will really direct your thinking and your strategies towards instruments that are low risk. And if you're single, for example, your risk aversion will go down. In other words, you will be a risk taker. You wouldn't worry about volatility or this sort of ups and downs in the market, right? So your financial status also will have an impact on the kind of instruments you trade. Obviously, some instruments are more expensive to trade than others, right? If you want to engage in things like gold bullion trading, or some sort of sophisticated trades involving options, derivatives, futures, that kind of stuff, you wouldn't want to have only 5,000 in the bank account, because if you lose that $5,000, you are going to be broke for a long time. But if you are wealthy, if you have 1 million or 2 million or 10 million, give or take, in the bank account, you can play around with that money. Take $1 million and just see how things play around, right? So your financial status definitely impacts the instruments that you can trade. This is the main reason why, if you are aware, for instance, if you are aware of something called a hedge fund or private equity group or a venture capital firm, those institutions cater to wealthy individuals, because the kind of instruments that a hedge fund buys and sells, or the kind of strategies that they have, involve a higher level of risk. So they are appealing to people who already have money and who can afford to lose a few bucks, a few $1,000, or a few million bucks, right? Not people who will be devastated if they just lost $10,000. So the financial status definitely will affect your the kind of instruments you're buying. Now, the ideal financial instruments to trade depends on a lot of factors. I only basically listed here a few, just to give you an idea of how things work when it comes to investment, and to let you know that it's all about your goals, it's all about your situation in life, and it's all about the financial markets themselves. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. I'm just glad that you are still around. If you enjoyed this content so far, if you learned something, if you feel that it's adding value to your life, please consider subscribing to our channel. I will really appreciate that. We drop a lot of good content every day, and we want to share as much great content as possible within the community and beyond the Sweetie Kiwi community. So subscribe and hit the bell notification button so you'll be notified every time we release a new show. Like this content if you feel it is adding value to your life. Share with people who maybe one right now there is someone who needs to hear this content to improve their lives, to make more money, to plan for retirement, to start investing. Please feel free to share the content with that person. Comment below. Let us know your experience with investment, your recommendations, your feedback, whether you're investing right now, where you are investing. Are you investing privately? Are you investing through a financial stock exchange? Share your wealth, share your intellectual wealth with the rest of the community. And most important, please continue being marvelous. Now, let's talk about where to invest. If you just joined us right now, we are giving right now, this show is about giving viewers and listeners a complete investment guide for newbies and veterans alike, particularly on what to trade, where to invest, when to take it easy and stay put, whom to trust, and how to make real money. Now, we've talked about how to, what to invest. We've talked about what to buy and sell, what to trade really. Now we want to talk about where to invest. Now, here are the things you have to consider before investing. If you want to pay for, say, retirement, college, or a home, you can invest your money to fund your goals, right? Before you invest, make sure you can answer all these questions. The following questions are very important. Now, first question, what type of earnings can you expect on your investments? Right? Would you get income in the form of interest, dividends, or rent? So, for instance, if you buy a share, if you buy corporate stock, right? Say you buy 100 shares in Google, you're getting dividends, right? Now, if you buy 100 bonds of IBM, for instance, you're getting dividends because a bond. You're getting interest income. You are getting interest because a bond will pay you interest income. It's called coupon, the coupon income. But a share, a company stock, pays you dividends, right? Now, if you invest in real estate, for instance, then you're getting rent in addition to the appreciation in the underlying asset, in the property. So think about what type of earnings you can expect on your investment. Another thing you want to think about is how quickly can you get your money if you need to sell or cash in your investments, right? Again, we are talking now about what? Liquidity, right? Liquidity is, if an instrument is highly liquid, it means you can quickly sell and cash in your investment. But if it's not liquid, you can sit around and sit on a book profit, on a paper profit, and not, be able to realize the income. So you can sell stocks, bonds, and shares and mutual funds at any time, right? Now, the thing is that there is no guarantee that you'll get back all the money you invested. That's for sure, right? Because investments involve a level of risk, a certain level of risk, right? Now, other investments such as CDs, certificates of deposit, or IRAs often limit when you can cash out, right? For instance, if you go to, for IRAs, it's the law, the IRS really tracks this part very, very, very strictly. So, you have limits around whether you should be 59 and a half years old or 65 years old, this kind of stuff. Now, for CDs, a bank might tell you, listen, you give us your money, we'll block the cash for 6 months or 12 years, 12 years, 12 months, right? So the bank might say, listen, you give us the cash, we'll lock the, we'll give you 1% or 10% or 5% for 12 months. But during those 12 months, you can't access your money. If you break the contract, if you access the money, if you break the CD lockout period, we are charging you some fee. We're charging you a fee. So, you have this sort of limit. Now, what can you expect to earn on your money? This is a very important thing. When it comes to expectations here, corporate bonds generally promise you a fixed return, right? So if you buy a corporate bond or if you buy a U.S. Treasury bond, you know how much you're getting in return. So for instance, if you buy, say, if you're lending, because buying a corporate bond means that you are lending money to a company, right, to an organization, to the issuer. The proper terminology is the issuer of a bond. So let's say Samsung, you buy a bond of Samsung at $100 or $1,000, and the coupon, the interest rate is 6%. Just to make things easy, let's say it's 10%, right? So every year you're getting interest income of $100. So 1,000 times 10% will be $100. So this is fixed. That's why it's called a fixed income product, right? Now, earnings, so bonds promise a fixed return, but earnings on most other securities go up and down with market changes, right? Stock indices, equities, ETFs, those things don't have a fixed return. It's important to know that if an investment has done well in the past, it's not guaranteed to do well in the future, right? That's why a lot of brokerages, a lot of asset management companies, a lot of a lot of those investment banks always give a disclaimer, always put a disclaimer telling people, listen, past performance is not an indication of future performance. Now, speaking about disclaimer, let me just quickly say here that I'm not a professional financial advisor. I'm not giving you financial advice. This show, the Sweetie Kiwi Show, is a general information show. If you have a specific question or you want to talk more about your personal situation, I would strongly advise you, if you're not a financial person, a financial expert, I will advise you to contact an expert who is well versed in the subtleties of the financial markets, who is well versed in the subtleties of the investment process, who has the education, who has the experience, who can really, really, really advise you, right? Okay, I think I kind of covered my back here. So let's talk about the amount of risk that is involved. Now, with any investment, there's always a risk that you will not get your money back, right? All the earnings promised. Any investments, maybe except the United States government, because you know that they will always be around because they have, usually most solid countries such as Germany, the UK, they have the ability to pay their bonds back. So investors are pretty comfortable, but for a company, anything is possible really when it comes to a company, because a company is a private entity and that is controlled by shareholders, and a lot of stuff can happen. So what I'm trying to say here is that risk is everywhere. So, but the thing is, there is usually a trade-off between risk and rewards, right? So the higher the potential return, the greater the risk, right? So this is one of the reasons why, for instance, the return on U.S. Treasury securities, whether U.S. Treasury bonds, U.S. Treasury bills, the return is not that high because the risk is also very low. So if the risk is low, the return will be low. Another thing you want to think about is diversification, right? Again, folks, here we are talking about things to consider before you invest. So you have to think about diversification. So make sure you don't put all your eggs in the same basket. Not at all. Never put all your eggs in the same basket. The grandma advice is always, good, not only in real life, but also in investment, right? Putting your money in a variety of investment options, which means diversifying, can really lower your risk. And that's where you want to get to. You want to get to a place where you're able to lower the risk, right? Some investments, if you have a properly diversified portfolio, what will happen is that over time you would see that you will just be sailing comfortably. You'll just be relaxing and making money and making some ka-ching, right? Because some investments will perform better than others in certain situations, right? So what will happen is that over time they will all balance themselves out. For if you have one industry that is struggling with, what's going to happen is another industry will prosper, and so on and so forth. So over the life of your portfolio, over 10 years, 20 years, or 30 years, you would see that you will be better off, because whatever goes down necessarily comes back up. unless there is like some kind of nuclear catastrophe. If not, a well-run company may have some, bad quarters. The stock price goes down, but ultimately it comes back up. The last thing you want to think about is the fiscal part of the investment. Are there any tax advantages to the particular investment you want to buy? Now, some investments are fiscally beneficial to you than others, right? For instance, anything that has to deal with the government is always interesting from a fiscal perspective. So United States savings bonds are exempt from state and local taxes, right? And municipal bonds are exempt from federal income tax. So sometimes you have to remember that state income tax is exempt as well, but it depends on the particular situation. So some tax deferred instruments with special goals, including college tuition and retirement, let you avoid paying income tax, right? Or sometimes they allow you to postpone the payment. So things, if you talk about IRA or 401k, the Roth IRA or the Roth 401k, those will allow you to postpone the payments of the income tax on the on the realized capital gain. We'll be right back right after this. Welcome back, folks, to another edition of Sweaty Kiwi. I'm very happy that you're still around with us. We are having a wonderful conversation. I enjoy talking about investment because it's helping people make more money, feel more comfortable, feel more wealthy and healthy. That's very great. We need to have fewer broke people in this world, right? Speaking of being broke, I hope that this program is giving you the insights, the ability to understand that to invest money, you don't need to be a millionaire. You don't need to have thousands upon thousands of dollars, right? The idea is to start. The idea is to start somewhere, even if it means investing $100. Because once you start, the momentum starts, and that's where you start learning, you start making more money, and then you start increasing your investments, right? Now, before we talk about invested in fixed income products, which is very important. I think I spoke about it earlier, but now I'm going to provide more details about it. Before I do that, I want to quickly give a shout out to some of our fans in Delaware, the beautiful state of Delaware. Ari Ayers in Tellyville, Delaware. Thank you so much, sir, for the support and encouragement. We really appreciate it. Addison Reed. Addison, ma'am, thank you so much. You are hailing from Rising Sun, Delaware. Beautiful city name. Appreciate it. And Early Wilson in Fenwick Island, Delaware. So Ari Ayers, Addison Reed, and Early Wilson, all in Delaware. Thank you so much for your support. Thank you for your encouragement. We really appreciate it. Now let's get right into it. Investing in corporate bonds. Now, if you're trying to invest in individual bonds, I explained earlier again what a corporate bond is, right? So if you buy a corporate bond, in essence, you are lending money to a company. You are lending money, and the company in return is paying you interest income. So it's called coupon. So they pay you on a quarterly basis or every 6 months or once a year, and they will be paying you interest over the loan term, the bond term, right? And at maturity, in other words, when the bond is expiring, the term of the bond is expiring, that this could be 5 years, 10 years, they will reimburse the capital. It's called the principal amount. So they will reimburse how much you invested in the bond, how much you invested in the company. So if you are going to invest in individual bonds, diversification through owning multiple bonds becomes more important, especially as you go lower on the quality ladder. What that means is that if you are trying to, if you want to buy the bonds of several companies, because some companies are rated higher than others, right? Depending on their financial situation, depending on their, a host of other things. But there are companies that specialize on rating corporate bonds. And those companies, there are several companies, but there are three that sort of have a monopoly on the industry. I call it, the triopoly. That's the triumvirate. The triumvirate. So you have Moody's, S&P's, and Fitch. So Moody's, Standard and Poor's, and Fitch. Those are the top three. Those are the biggie that sort of control the corporate bond rating market, and they even rate the bonds of countries also. So their job does not stop at evaluating the soundness of companies. They also evaluate the financial soundness of organizations, of cities, of states, of countries. So whenever an organization or a public entity is trying to borrow on financial markets, they will be covered by Moody's, Standard & Poor's, and Fitch. That's just the bottom line. If you want investors to give you money, then you need to be evaluated by those three biggies. So the risk of default is much greater when you have a company that's rated low by those top three that I was telling you about, right? So it is very important that when you have, if you have a bond strategy, you want to invest in the bond market, that you are able to diversify. Now, let's just get to the nitty gritty here. A company that has an awful rating is called, in finance parlance, is called junk. In other words, this is a company that investors should be very worried about. If you buy if you buy the bonds of this kind of companies, chances are you might be having nightmares every day. You might be thinking, wow, something might happen to the company, in the next few days or months or whatever. But there are some investors who love that sort of risks. That's sort of adrenaline, right? Again, if you remember, the kind of instruments you buy depends on a lot of things, and one of the things is how much money you already have, right? Your financial status. So if you're set, if you're comfortable, you can really you can afford taking risks, right? So this is one of those things that you need to think about. Now let's talk about very quickly what it means. So credit risk, the credit risk, there are some terminology. So if you have something like investment grade means this is a top-notch company. You can buy the bond and basically nothing will happen. This is a solid company. So investment grade usually is, that rating is usually assigned to countries, right? So if you have countries and also top companies, so company like Apple or a company like Google, Alphabet now. If you have a country like the United States or Germany, those are countries that are solid, and investors know that not only they have the fiscal levying capacity, so they can levy taxes, but they're also well run, right? Now, after that, you have companies that are rated AAA. AAA meaning again, it's very close to investment grade. It's very top notch. And when you go all the way, so after AAA, you have AA and then A, and then you have a triple B, that kind of stuff, and you go all the way down to junk territory. And after that, below that, you have those companies that are already in default. So the thing is, when we have to buy, if you want to buy a bond, make sure that you look at the rating of the bond, right? My advice here is, especially if you're a newbie or even if you're a veteran, you're a veteran investor, go with well-rated bonds, especially from big banks big companies, they have enough dough in the bank already. Do the same thing as lenders. Do the same thing that lenders do, right? They would rather lend to people who are already wealthy and don't really need the money. So do the same. Buy the bonds of the biggies. Buy the bonds of Apple, Samsung, Facebook, Alphabet, Microsoft, IBM. Those big companies, they have tons of cash already in the bank, right? We'll be right back right after this. Don't go anywhere. Welcome back, folks, to another section of Sweetie Kiwi. the Sweetie Key, we show the world's largest infotainment show. Are you still around? Are you having fun? Are you enjoying this? Are you grabbing a cup of coffee, tea, or vodka? Not really vodka, because you still need to be conscious, right, to understand what I'm talking about. Let's just really get into it, right? So I want to first give a shout out to some fans here. I mean, we appreciate the support, and we always make it a habit to acknowledge some fans throughout the program. So Ray and Solomon in Achopi, Florida, we love you and your family. Thank you so much. Brooke Blanchard in Pretty Bayou in Florida, thank you so much for your support. Really appreciate that. Gia Schmitz in Bushnell, Florida, beautiful state of Florida, sunny state of Florida. Thank you so much, Gia Schmitz, Brooke Blanchard, and Ray and Solomon in Florida. Thank you so much. Now let's continue. Let's keep on with the conversation about corporate bonds. Now we've talked about bonds. We've talked about corporate bonds in the previous section. I want to talk now about another type of bonds, but this time the government bonds. Right now, by government here, I'm focusing more on the United States government bonds. Now, most countries have their own bonds, but in this program, we are focusing on bonds that have been issued by the United States government. Now, you have several types of bonds, right? You have treasury securities, you have savings bonds, and I'm going to quickly go into each type. Now, treasury securities, as I said earlier, United States government bonds can give you the highest peace of mind you can ever imagine, right? Because nothing is going to happen to the government. The government will always be able to levy taxes. So this is not a company that needs to sell products or services to earn money. The government has a right to levy taxes and to fund its operations. So the money will always be there, right? At least that's what we hope. That's what everybody will hope. So going back to the two types of bonds that we're talking about here, you have treasury securities. Now, treasury securities are debts that the federal government issues, right? And basically, within the federal government, there is a specific department that is called, there is an agency actually, and it's called the Bureau of Fiscal Service, right? And when you buy a treasury security, you are, in essence, as I said before, lending money to the federal government of the United States for a set amount of time, right? It could be 3 months, 6 months, 1 year, 10 years, doesn't matter. But it's always indicated on the coupon, right? So you know how long you are lending the government money. The government will repay the entire amount, which is called the face value, when the security arrives at maturity. In other words, when the security matures, and the maturity here is the length of time, is the length of how many days, how many months, how many weeks, how many years, right? Now, there are several types of treasury securities. There are something called Series EE and Series I savings bonds. Now, those are securities that offer a fixed interest rate over a fixed period of time. So it could be 2% over 2 years or 2% over 5 years. Then you have treasury bills. Now, those are short-term securities that mature between a few days and 52 weeks. Now, in financial parlance or in accounting parlance, when people talk about short-term, it's usually within 365 days. That's what short-term means. So the treasury bills, if you buy treasury bills, you are able to get your money back plus interest within 1 year. And then you have treasury notes. Now, treasury notes are medium-term securities that mature between 1 and 10 years. Again, when you're talking about accounting or finance parlance, medium term stands for a time span ranging from 1 year to 10 years. This is why treasury notes are medium-term securities. And then you have treasury bonds. Now, treasury bonds are long-term securities with a 30-year term. So they're kind of similar to a mortgage, right? So you have 30-year mortgage, so you have a 30-year. When you buy treasury bonds, those are long-term securities. They have a 30-year term. Now, those bonds, the treasury bonds, pay interest every 6 months until the bond matures. Now, remember, if you buy a treasury bond, you don't have to be stuck with the government, so to speak, for 30 years. You can resell that bond because it is a financial instrument, right? So there is a market for that. There's a market for treasury bonds. So if you buy them today, you don't have to wait for 30 years before you resell them. You can resell them tomorrow, right? So you can buy them today and resell them tomorrow. So it's and U.S. Treasury instruments, U.S. Treasury bonds are highly liquid. Highly liquid. A lot of people buy them, including institutions, a lot of central banks, a lot of big organizations, a lot of private companies, a lot of publicly traded companies buy U.S. Treasury bonds. So it is a very liquid instrument. You also have something called floating rate notes. Now those are 2-year term securities with variable interest rates. You also have the TIPS. Now the TIPS are my favorite because they are very flexible. They offer a lot of flexibility. They're called TIPS, and TIPS stands for Treasury Inflation Protected Securities. Now those securities, let me repeat that. TIPS stands for Treasury Inflation Protected Securities. Now those are securities with principal values that change based on inflation, right? But they have fixed interest rates for 5, 10, or 30-year maturities. So this is very an interesting thing to know about. Now, let me just say that you can buy treasury securities for yourself or as gifts, in several ways. You can buy them through your bank, through banks, brokers, and other financial institutions, right? You can also buy this government instruments online through Treasury Direct. There is a website called Treasury Direct. So it's actually www.treasurydirect.gov. So that's RYDIRECT. So Treasury Direct, 2 words combined, .gov. And you can buy the Treasury securities there. You can also have something called payroll savings plans. So you can invest in savings bonds through payroll direct deposit. So you tell your company, you tell HR to carve out a part of your earnings every 2 weeks or every week, and automatically invest that in treasury securities. There are also something called public auctions, where you buy securities directly from the treasury at an auction. Now this is interesting, but usually it's very crowded by big banks. So the big banks, the central banks, the biggies of the financial markets, they usually participate in those auctions. So I would, as a retail investor, I would not advise you to do that. I think that it's just easier to go through your bank or brokerage institution, or just go directly through Treasury Direct and just buy the instruments there. Now you also have the savings bonds. As I said earlier, savings bonds are usually one of the safest type of investments really in the whole world, because again, they are endorsed by the federal government, right? For if you remember what happened in 2008, a lot of big banks were bailed out, right? They received funding from the federal government. So imagine if the federal government is able to bail other institutions out, what will happen if the government itself were to be in financial trouble? I mean, it can never be, because the United States is the top power, is the world's #1 power, not only in terms of political clout, but also financially here. So you have Wall Street here. So the government has the money, has the resources to take care of itself. Let's just say it this way. So U.S. savings bonds are one of the safest types of investment because of that, direct government backing. So You can learn more about savings bonds by going to Treasury Direct, as I said. But the bottom line here is that fixed income products, specifically government bonds, are safe. But the drawback is that the return is very low, right? Because the risk is low and the return is low. So this is something that might be good for people who are risk averse. So if you are risk averse and you just want to have something that will grow at, maybe you want to have an investment that will grow at, say, 1% a year, you don't really care about, you don't care about how long it will take for you to become a millionaire or a multimillionaire, then I would say go for U.S. Treasury bonds. One thing that you can also do is try to have a diverse basket, a diverse portfolio. So you have a little bit of government bonds, a little bit of corporate bonds, and a little bit of stocks, a little bit of stock indices, a little bit of ETFs, and so on and so forth. So you have a nice portfolio of financial instruments, right? Okay, we'll be right back right after this. Welcome back, folks, to Sweaty Kiwi. We're still having a conversation about investments, about making money, about saving money, about growing the portfolio. This is very important. This is something we enjoy doing. And now, so we talked about regular financial instruments. We talked about government products. We talked about fixed income. Now I want to talk to you about investing in other products. So equity, exotics products. So a wide variety of investment products exist to help you achieve your financial goals, right? So, you have several categories of investment products. Now, we already talked about stocks. We talked about bonds. Now, we talked a little bit about ETFs earlier. Now, mutual funds are similar to ETF, but the only difference is that you are actually, giving the money to a mutual fund, another institution for you to manage. So that institution is creating a pool of liquidity. So they're taking money from multiple investors, right? And they're creating a pool of cash. And based on that pool, they are investing in specific, sectors. Now, mutual funds have fees. So that's also one thing you want to think about if you want to invest in a mutual fund. Now, you can also invest in insurance products such as variable annuities. Now, we have an entire show on annuities and insurance, and you might want to check out that show to learn more about variable annuity and fixed annuities. One thing you want to remember here is that every investment product that you choose has its own general set of features, including the level of risk and the anticipated return. Which is why, as I said earlier, it's always important to reach out to a financial professional, a financial advisor, a CPA, a wealth manager, a private banker, an asset manager, somebody who is well immersed in the financial details of today's world, in the details of the financial markets, to advise you. Right? There is something else that I want to talk about. I think I already talked about it before, but I want to emphasize it again. You have to always remember the risk and rewards equation. And this is very key because the symmetry the symmetry of financial markets is filled with people who have played around with the markets, have used high risk, and when things went bad, they lost it all. And some investors even committed suicide. I'm not naming names here, but if you Google investors who committed suicides after losing money, there are plenty of them. So the bottom line here is that there is a correlation here between risk and return, and what you're really trying to do is achieve a sustainable path towards wealth. And by that, one of the things you want to do is you want to control the risk and return duality, the risk and return equation, right? Risk means how safe your money will be, and the return is simply how fast your money will grow. right? So as I said, there is a direct correlation, right? So generally, as investment risks rise, investors seek higher returns. But be careful, you can lose all the money you invest, including your principal, right? So for instance, if a company files for bankruptcy, and you have the stock of that company, for instance, what happens, the share has no more value, right? So you lose it all. You lose it all. So risk and return aren't the only considerations when deciding what type of investment products to invest in. There are four other things you want to sort of think about here, and this is very important. So the fees. Now we talked about earlier. Here I'm talking about transaction fees. How much it costs to invest. And here I'm not just talking about the brokerage fees. Because you have a risk that the bank or the brokerage company is passing on to you, right? That's one. But you also have something like, the transaction cost at the market level. So you want to consider those things, because this could affect your return on investment. I'll give you a simple example now. It might be a little complex, but I'm going to break it down. In forex, in foreign exchange, there is something called carryover. So depending on the interest rate differential among two currencies, you either get a credit to your account every day at 5 p.m. New York time, or you get a debit. So that is basically the play between the interest differential. So for instance, that's what I call the market cost. So if, for instance, the United States has, let's say the central bank has the basic rate at 3%, and the euro is at 4, the ECB, the European Central Bank, has fixed its basic rate at 4%. There is a differential of 1%. Right, so the Federal Reserve has 3%, and the ECB has 4%. The differential here is 1%. So investors, or if somebody buys the euro and sells the dollar, that person will want to be compensated every day at 5 p.m. Eastern Standard Time for the 1% differential. So this is what I call a market cost. Now, we have another show coming up to talk about Forex more in detail, but I just wanted to explain to you that transaction costs can be diverse. They can be many costs. There is something called asset allocation. I already talked about that when it comes to diversification. One thing I want to talk about when it comes to diversification is that diversification is not just at the dimension of the products. We're not talking about the instrument itself. You can also consider diversification from a geographic perspective. In other words, you can buy the shares of companies, of foreign companies, right? You can be in the United States somewhere in Idaho and buy shares from a German company. That's also called diversification, right? So you don't have to just diversify by sector. You can also diversify by region, and that should be something that a lot of experts recommend, because again, what you are trying to achieve is, if the U.S. market is down and another market, for instance, Asia is up, and you have some Asian assets in your portfolio, you are able to basically have a well-balanced portfolio. So you don't have those sort of major up and down, the major ups and downs. So that's very important. Another thing you want to consider is, before deciding which investment products you should buy or you should trade, is something called fraud, the potential for investment fraud. And this is what I'm going to talk about in the next section. We'll be right back right after this. Don't go anywhere. Welcome back to Sweaty Kiwi, folks. I'm very happy to have you around here. It's just wonderful to talk to you about this very interesting topic: investment, making money, growing your wealth, becoming financially independent. Those are things I really like. So I hope you are having a marvelous time, because I'm having a marvelous time. And in this show, I'm giving you the complete, easy peasy investment guide for newbies and veterans alike. What to trade, where to invest, when to take it easy and stay put, whom to trust, and how to make real money. Now, if you are a newbie, you certainly want to to pay attention. If you are a veteran investor, you really want to pay attention too. Why? Because sometimes we may forget the basics of investments, and we just want to stick to our own principles and our own assumptions. No, sometimes it's good to go back to basics to understand what makes the whole financial industry or financial markets be what they are, and how to make real money. And this is what I'm teaching you in this show. Now, let's quickly talk about investment fraud. But before we get into that, because I know everybody just like, ooh, I'm just listening like crazy. Before we get into that, another fan shout out section. Want to quickly give a shout out to Lane Long from Madras, Georgia. Alexis Russo from Milner, Georgia. It's a Lot from Eatonton, Georgia. So Lane Long, Alexis Russo, and It's a Lot from Georgia. We appreciate you. Thank you so much. We bless you and your families. Thank you so much for your support. Now, if you just join us, we are talking about investments. And if you like this show so far, if you have been listening to this for a while now, for the last 10 minutes, 20 minutes, and you appreciate what we are giving you as content, please consider subscribing to our channel. And turn on the notification bell so that you can be kept in the loop whenever we drop a new show every single day. We drop these beautiful shows once a day, or twice a day, or 5 times a day, depending on our inspiration. Consider liking the content. Consider subscribing, sharing, comment below. Give us your experience, your stories about investment. We always want to know. And one thing also that I want to sort of emphasize it here is that this show is ad supported. So please watch the ads that are being served to you as during the show. We'll really appreciate that. Our team needs to have the resources to conduct. The production team needs to grow, to expand, so we can cover more topics. We can bring you more relevant content, and we'll really appreciate that. Now, let's talk about what you can do to avoid investment fraud. This is very important, folks. Very important. Everybody wants to get rich, right? Everybody's trying to really make a $1 million or 1,000, 10,000, whatever, right? Doesn't really matter. But everybody is engaged in this financial game of always making more money. And sometimes some people are ill-intentioned, and they're trying to take advantage of the naivete or the inexperience of certain people. So how can you avoid investment fraud? Ask questions. That's the first one. Ask questions. Now, fraudsters, scammers are counting on you not to investigate before you invest, right? So do your own digging. It's not enough to ask for more information or references, right? Because the scammers are very good at that. So you want to investigate more before you invest. Now, I would advise you to always have a financial advisor or an investment professionals. But if you want to do things on your own and you don't have the resources yet to hire those people, do your due diligence. Ask questions. Research before you invest, right? So if you get an unsolicited email, message board posting, or company's news release, this kind of stuff, don't fall for that, right? Understand the company's business and its products or services before investing. Look for the company's financial statements on the SEC EDGAR filing system. Now, the SEC is the U.S. Securities and Exchange Commission. This is a government agency, and they maintain something called EDGAR filing system. So go on EDGAR, search EDGAR, and find out if this company is legit. find out, learn more about the financials, about their history, their operational history, the management, the experience of the management, this kind of stuff, right? You want to know which company, where are you putting your money. This just makes sense. Use the same common sense you use when buying, food for your child. That's just the way I put it. Use common sense. Now, you want to know the salesperson, right? So spend some time checking out the person who is touting the investment before you even think about investing. Even if you know the person socially, now before you put some money on the table, try to take the chance to know the person professionally, right? You want to check their backgrounds. You want to look at their LinkedIn profile. You want them to send you references. You want to check their references. You just want to check them out. Always find out whether the securities salesperson who is contacting you is licensed to sell securities in your state, right? Because this is very important. Most states want securities salespeople to have license. They need to be licensed. And the thing is that sometimes these licensed salespeople, they or their firms might have some runnings with regulators or other investors. So if they tell you that they are really, they are licensed, you can check out if they have some runnings with authorities, and you can check out the disciplinary history of brokers, advisors, and you can do so for free using the SEC online database. As a matter of fact, there's another organization called FINRA. They also maintain databases, so you can actually even contact your state securities regulator to have more information. So my point here is that you want to ask as many info as possible, right? Now, be always wary of unsolicited offers, especially if you receive an unsolicited pitch to invest in a company, or you see it praised online and you can't find any other information. Don't fall for that. It's very important. And another thing you want to do, you want to also do, is that make sure that you protect yourself. Protect yourself online. Protect your info, because a lot of online and marketing, online and social marketing sites, what they do is they offer, a wealth of opportunity for scammers. So try to protect your social media accounts. Try to protect what you show. Don't show anything that is too revealing on social media, because again, those scammers, for them, that's just the playground. They can use whatever info you post there to turn around and scam you, right? So here are some red flags for fraud and common persuasion tactics, right? So one thing for sure, if it sounds too good to be true, it is. Okay, if somebody's telling you guaranteed returns, don't fall for that. Guaranteed returns aren't guaranteed, right? There is also one thing that's very important, is that beware the halo effect. There's something called the halo effect. What happens is that, investors sometimes can be blinded by a halo effect. And this happens, for instance, when, you have a con artist comes across as likable, very well dressed, very charming, very charismatic. They look the part. They are trustworthy. Credibility can be faked, right? So you want to always check out the actual qualifications of the person, right? This is very important. Now, if somebody's just pressuring you to send money right now, because this happens a lot. So a scam artist sometimes, they tell you, this is a once in a lifetime offer and it'll be gone tomorrow. So you need to invest in this now, because this is a 20% return opportunity, and it's a once in a lifetime opportunity, and it will be gone tomorrow. Well, let it go tomorrow. Let it be gone. The good thing is tomorrow you'll still have your money in the bank account, right? So resist the pressure to invest quickly and take the time you need to investigate before sending money. So this is very important. And another thing that you need to think about here is that you want to avoid falling for something that says, everyone is buying it. So you have pitches sometimes that that indicate things like, yeah, everyone is buying it, right? So everyone is investing in this, so you should do the same thing. Think about whether you are interested in the product. Think about whether you aren't interested in the security, in this investment product, right? So if a sales presentation focuses on how many others have bought the products, this could be a red flag. Again, the idea here is that the point I'm trying to get across here is do your own due diligence, right? You don't have to have a PhD in financial mathematics or investment management to understand common sense. In some cases, somebody comes to you and wants you to, and is telling you that something is too good. The return is 30%, 50%, right? Everybody else is doing it. You have the halo effect. People are coming very well dressed. They could talk the part. They are very charismatic. They they're very skilled when it comes to talking. They're able to make their point across. All this stuff is pretty good, but always check and double check, and I would add triple check. And by triple checking, you always want to contact the authorities. Always want to contact for instance, when it comes to investment, contact the SEC. Not contact, you don't have to contact them. They don't have the time for that. You want to read. You want to go online and look at things like Edgar or the online database for FINRA, this kind of stuff. Contact your state securities regulators. Contact your state banking regulators. Contact the authorities and do your own research. All right, we'll be right back right after this. Welcome back, folks, to we're still here talking about investments. I hope you are enjoying the show. I am enjoying the show. I am just having a great time talking about money. I love talking about money. Money. Okay, where were we? So, yeah, I think talking about fraud just kind of put me in a down position. All right, let's just come back here and talk about something more positive here. Now, I want to talk to you about investing overseas. Again, this is a complete investment guide, so you have to stick with me here. And this is a guide for newbies and veterans alike. So I'm spending time a little bit on breaking down certain concepts. I'm trying to steer clear of complicated terminology, because the bottom line here is to make sure everybody leaves, everybody goes home. After watching and listening to this show, everybody goes home with a clear understanding of what he or she needs to do to start investing, to start making money, and clear the path for a multi-million-dollar, payday. So investing overseas, I spoke briefly about it before. It's a great opportunity, right? So you want to diversify. When it comes to diversification, right? There is an opportunity also from geographic diversification. So foreign stock market has gone through a tumultuous time in the last 6, 12, 24 months, 36 months, doesn't matter. What's really happening here is that if investor activity ebbs and flows with market sentiments, it's good. It's a good thing, right? Investors are trying to capture what people call market sentiments. Now, this happens every few years. If you are a student of financial markets like me, in the last 50 years or 70 years, you would see that every now and then, every 5 years, 10 years, depending on your point of view, the market goes through some deep stuff, right? Deep deleterious stuff, deep negative stuff, right? So you can tell that, diversification is important, because you have an efficient, when your investing is efficient, that means that your portfolio is diversified, and vice versa. So, you don't want to limit the diversification of your portfolio to local markets only. It's important to distribute your money among local mutual funds, but also international funds. Again, here I'm not asking you to go into anything sophisticated. No, just take it easy. Don't try to reinvent the wheel. There are people called value investors like Warren Buffett. One of the richest men on earth, and he is just taking it very easy, nothing complicated. Try to diversify. Now, why do you want to diversify? Why should you diversify and invest overseas? Number one, you can actually get higher returns, right? Right now, the United States is going through around our growth is around 2%, 3%. We are a mature industry. We are a mature economy, right? Now, some sectors are growing at double digits, but as a country, we are so big, it's very difficult to grow at 10% at 2 digits, right? So give or take, we are around 3, 4, 5%. Doesn't really matter. Sometimes we go to 1%. Some economists don't even listen to government figures anymore because they think those figures are manipulated, but doesn't really matter. For me, what matters here is that if the US economy is slow growing, you can look around in Asia, in Africa, in Latin America, where you have countries that are growing at double digits, right? So in Asia, you have Vietnam, you have Laos, you have Indonesia. You have those countries that are growing at double digits. In Europe, you have Lithuania, you have Estonia. Those are countries that may be smaller, but they are growing at double digits. So there are opportunities for investment. Again, and you can find well-run companies in those countries to invest in. If you go to Africa, you have a country like Botswana or Angola that is growing very, very like crazy, right? You have Nigeria that is growing like crazy. You go to Latin America, you have Chile and Argentina and Brazil, right? So the picture I'm trying to paint here is that you want to diversify your portfolio so you can grow more. So if the US market is growing at, I don't know, give or take 10%, and another country is growing at 20% to 30%, you would be better off just putting a little bit of cash into a foreign market, right? So that's one, the return is maybe higher. You also have something called the currency advantage, right? So for instance, if one country has a higher value, if one country has a currency that is higher than the US dollar, you can make money not only in terms of the appreciation of the instruments of the stock, for instance, but you also make money in terms of the currency differential. So you have currency gains, right? For instance, you have, the British pound is higher than the US dollar. So if you invest in the UK economy and you make money there, if you buy the stock or bonds of a UK company, of a British company, and the stock or bonds rises in value, you are making money not only in terms of, you're making in terms of the value appreciation of the underlying instruments. You're also making money in terms of the currency differential here. So the currency delta is really in your favor here. So right now, as of the date of this show, the value of the US dollar is lower than the British pound, and the same scenario also is seen with the euro. So you have the situations where you can make money from the currency differential. You also have something called information advantage. Now some countries have they are still in the growth stage, right? They are growing, but not all investors are aware of their growth trends, for instance. So if you go in a country like India, there are a lot of companies that are very agile, they're very making things happen, but because of the larger context of the Indian economy, investors in the West aren't aware of the of the company yet, right? So this is now maybe the best time to invest in those companies, because by the time they are growing, by the time they have become big, all the big investors would have known about them and would have put money in them. That's what angel investors do very well, and that's what private equity firms also do very well. They are able to look at those companies that are struggling, or the companies that are just coming on the local stage, on the local market, and they just need finance. They just need money to be able to deploy their commercial strategies. So finding those jewels very early on can give you a humongous payday. But the thing is that you cannot have those in the United States, because the information is available, is readily available, and the competition is just very high here, as opposed to somewhere in Asia or Africa or Latin America or Europe. We'll be right back right after this. Welcome back, folks, to this series about investment. We're still digging deeper into what it means to be an investor, a good investor, how to make money safely. And our job here is to teach you how to make money. Now, I want to tell you more about whom to trust, right? It's very important whom to trust as you are trying to embark on an investment journey. It's important to have the right professionals around you, right? So I want you to choose the right financial professional. Now, before we talked about that, I want to quickly tell you that it's always a pleasure to acknowledge fans and viewers and listeners who support us, who give us the power, the encouragement, things that we need to move forward. And I want to acknowledge today Max Fox in Hawaiian Paradise Park in Hawaii, Dane Edwards in Wailua Homesteads, and that's in Hawaii, and Chelsea Chambers in Laonio Poko in Hawaii. Max Fox, Dane Edwards, and Chelsea Chambers, thank you so much for your support. We really appreciate that. Who do you have to trust, right? Whom to trust. Now, financial professionals provide products and services that include things like financial planning, insurance, and investment, right? Some are licensed, and they can even have multiple titles that depend on the services they offer. Now, some of those titles can be very impressive. Now, before you have to research financial professionals, it is important that you understand what the titles and licenses mean. Don't be confused or embarrassed or overwhelmed by their titles, right? You can research that and know what it means. Those are just titles. It's important to look up their educational, work experience, and ethical requirements. Folks, this is the key word here. Ethical requirements, right? Because we spent a whole section not long ago talking about fraud. So you want to be comfortable that the person who is giving you advice is himself or herself not a scammer, right? Keep in mind that a professional title is not the same as a license. Very important. Now, the Securities and Exchange Commission, the FINRA, so that's the Financial Industry Regulation Authority, and state regulators, they do not grant or endorse any professional titles. So professional titles are granted by private organizations, right? There are, those organizations are sometimes nonprofits, professional organizations. So they grant the titles. What licenses are granted by government body or a body that has been authorized by the government to grant licenses. So the SEC, the FINRA, or the state regulators are the one who grants licenses. So it's very important to you got to ask yourself certain questions before choosing a financial professional. So before selecting a broker or investment advisor, make sure that you research their education, professional history, the firm they work for. Then make sure that you have answers to the below questions that I'm going to give you. There are some critical questions that you need to have answers for. Now, Number one, first question: do you communicate very well with the advisor? Is the relationship like on the positive side? Do you have a great communication relationship with this advisor? It is important to make sure that the financial advisor that you are about to hire listen to your needs and keeps you updated on your investments. This is a biggie. If the person doesn't respect you enough to listen to your needs and keep you updated on your investments, it's time to fire him or her. Another question you need to ask yourself is, has this financial advisor worked with others who have circumstances similar to mine? Right? So you want to place yourself in a position where you want to know if your potential financial advisor can understand your lifestyle and financial needs, right? So you want to make sure that they have worked with people who have similar circumstances to yours. Is the person licensed in your state? So one thing that's very, and this is very easy to do. This is easy peasy. You need to contact your state regulators. Contact your state securities regulator to find out if the financial advisor you are about to hire is licensed in your state. So the state security regulators will give you the list of individuals and firms that are registered in your state. And this is very easy to find. You just go online on the state securities regulators website and you can get all the info that you need. And you want to ask whether the regulatory office has any other background information, right? You want to dig as deeper as possible. Another question that is very important is you want to ask yourself whether or not the financial advisor has had any problems with the regulators or received complaints from investors. So one thing you want to do is you want to search for individuals with court or commission orders against them. This is a big one too, because people on this list, they have been asked to appear before the SEC federal court, right? Or they have been named as defendant in SEC administrative proceedings. So you want to really get better at knowing and having a background check about those people. Use also FINRA. FINRA, again, is the financial industry regulatory authority. Use FINRA's broker check tool. They have a tool called broker check, right? You want to use that tool to review things like, employment, licensing, and disciplinary action against financial brokers, firms, or advisors. So you have a whole area of tools and devices, if you will, to check the background of any person you are considering hiring for the financial advisor role. Now, one thing you need to also ask yourself, and you want to have a clear answer to this, you want to know, how is the person paid? Is it an hourly rate, a flat fee, a commission that is based on the investment that they make? Does the person get a bonus from their firm for selling you a particular product? It's very important because normally independent advisors, they don't need to promote specific funds, right? So this is why you want to really go for an independent advisors, because if you go for somebody else, they're not, if you go for someone who is getting a bonus based on their sales to you, their sales of a particular product to you, you're not getting flexible investment options, because they are only offering you what they can make money off of. Another thing that you want to ask also that's very important is, what are the fees for setting up and servicing the account? So a lot of companies have a variable fee schedule when it comes to account servicing. So you want to know how much they are charging. So firms can charge fees based on the number of trades or the amount of your asset. So that's very important. So if you intend to have an account and have a very low number of trades, then you're better off going with a company that charges on the number of trades, right? But if by contrast the company is charging you on the charging you a percentage of your assets, then you better go with a company that charges on the number of trades, right? So this is really, I'm just gonna give you in the first section here how the questions you need to ask while trying to choose a financial professional. I will be right back right after this. Welcome back, folks, to we are still here at Sweet Kiwi. We are exploring the beautiful world of investments. We are learning how to make great investment decisions, how to learn from our mistakes, how to learn from things that can improve our lives. This is very important, and I'm actually going to talk to you now about how to choose a reputable and, if possible, a certified professionals. Now, I said earlier that some licensing is the purview of state securities regulators, but titles and designations are the purview of professional nonprofits, right? So private organizations, right? Non-governmental organizations. However, some designations and titles are more prestigious than others when it comes to choosing a financial advisor, right? So many state securities, many state securities and insurance regulators, they don't allow financial professionals to use a designation, right? A particular something like senior designation, unless it has been accredited by either the American National Standards Institute or the National Commission for Certifying Agencies. Now, remember those two things, those two organizations. So the American National Standards Institute or the National Commission for Certifying Agencies. Now, when it comes to financial advice, when it comes to financial planning, when it comes to investment advice, designations that have been accredited by the American National Standard Institute include, accredited investment fiduciary, certified investment management analyst, certified senior advisor, accredited financial counselor AFC, certified financial planner CFP, certified Medicaid planner CMP, certified retirement counselor CRC, certified retirement financial advisor CRFA, certified senior advisor, or I think I already said that, life and annuity security professional, this is LACP, master registered financial consultant MRFC. Now these are just a few accreditations, a few designations. They're very, very prestigious in the investment community. Now, one thing that I also want to talk about here is that by knowing those designations here, you are able to know whether or not the professional in front of you is legit, has the qualifications that he or she is claiming for giving advice, right? Now, let me ask you a question. Let me ask the audience a question. And I want everybody to comment below and let us know if you have you interacted with a financial advisor in the past. Have you hired a financial advisor in the past? If so, can you please tell us whether or not the person had a title, in other words, a designation, and if they did you see that there was a strong correlation in performance, between their title, their designation, and their performance? In other words, did the designation have an impact on the performance in terms of the advice they give you? I'll be very, very interested to know more about that, because this is a great field for a lot of people to learn more and to understand some of the things that are happening. So please comment below. Let us know your experience. Let us know your interactions with investment professionals. Let us know if you are an investment professional, your investment professional yourself. Let us know how you are able to get new clients, how you pitch your designation or your accreditation to them, and whether or not it has a whether or not it makes a difference. So for those who just joining us, we are talking about how to make money. We are talking about how to trade, right? This is really the complete easy peasy investment guide for newbies and veterans alike. I'm showing you what to trade, where to trade, when to take it easy and stay put, whom to trust, and how to make real money, right? So one thing that I want to quickly talk about here is that this guide is not only for newbies but also for veteran investors, because we are going back to some core basic truths when it comes to investments. And by doing that, I want to make sure that everybody, after listening to this show, can start making some ka-ching, start making some money. Now, if you like this content so far, please consider subscribing to our channel and hit the notification bell so you can be notified whenever we drop a new show. We do so every single day. Please like the content right now so we can have a boost in search engines. Please share the content with other people who you believe might enjoy and learn from this content. Please comment below, answer the questions, show us your insight about this particular topic. And also, one thing that's very important is please consider watching the ads that we serve on this show. This show is ad supported, and we are able, with the resources that we have, our team needs more resources to expand. We want to cover more topics. We want to investigate more topics, and we want to be able to provide free quality that is high. We want to provide free content that is high quality. Thank you very much. I'll be right back right after this. Welcome back, folks. This is Sweetie Kiwi, your favorite show. We are back at it. We are back. So we want to talk now about, I talked earlier about a few designations that are important, but I want to continue. The list is not exhaustive, and I want to make sure that I spend a few minutes more to talk about a few other important designations that you can trust. They have not been accredited by the National Commission for Certifying Agencies or the American National Standards Institute, but they are very prestigious in the financial industry. Now, before I mention again this designation, I want to really quickly give a shout out to Cameron Moore in Clover, Idaho. She is a great, that's a he, yeah. He is a great supporter, a great fan, a great listener of this show. Danny Cole in St. Mary's in Idaho, and Shannon Saunders in Kellogg, Idaho. So Shannon Saunders, Danny Cole, and Cameron Moore, thank you so much, all the way from Idaho. We love you. We love your respective families. Thank you for the support. Really deeply appreciate it. Now, let's talk quickly about a few designations that you can trust when it comes to investments. Now, again, you can trust the titles, you can trust the designation, but it doesn't mean that you are not making your own due diligence, right? You need to double check, triple check, call the state's authorities, contact the SEC and dig more about the individual before making an investment decision, right? Before sending money to anybody. So one designation that you can trust is the accredited estate planner. Now, the accredited estate planner it's a strong designation. It is offered by the National Association of Estate Planners and Counsels. In the industry, it has good reputation, and the continuing education requirements for this designation are very strong. They're solid, so this is a good one to trust. You also have something called the accredited financial analyst. Now, accredited financial analysts are also very, very, very respected, and they're very knowledgeable. And this designation is offered by the Global Academy of Finance and Management. And usually, to attain this designation, professionals need 3 years of experience minimum in financial planning or in asset management and financial planning. So this is a great one also. Another one is Enrolled agent. Now, an enrolled agent is this is one of the top accreditation in my view, the top accreditations in my view, because this designation is offered by the Internal Revenue Service. So the IRS, yes, the IRS grants this designation to professionals who, have passed very stringent exams. And if somebody has an enrolled agent designation, they know a lot about taxes, right? And taxes are intimately linked to investment, especially if you want to think about things like estate planning or IRA, Roth IRA, 401k, this kind of stuff. Next one is the accredited management accountant designation. This is an important one too. This one is offered by the Global Academy of Finance and Management. Again, this is a strong designation also. Next, financial analyst designate. The financial analyst designate is the FAD. Hopefully it's not a fad. They're not being fad, but the financial analyst designate is actually, it's issued or is granted by the American Academy of Financial Management, the AAFM. And before it was known as the Chartered Market Analyst. Now they changed the designation, so now they're called Financial Analyst Designate. Again, if someone introduces themselves to you with that designation, you can trust at least the quality of the background, the quality of the educational background, and you can give them a chance to make the pitch. Another designation that you can trust is Life and Annuity Certified Professionals. Life and Annuity Certified Professional, LACP. This is a good one. It is issued by the National Association of Insurance and Financial Advisors Certification Commission. Let me repeat that. It is issued by the National Association of Insurance and Financial Advisors Certification Commission, and this is a solid one also. Another one you want to give a chance to, another designation that you want to have respect for, is the Master Registered Financial Consultant, the MRFC. This designation is very great because it is issued by a strong organization. This is, issued by the International Association of Registered Financial Consultants, the IARFC, and it's called MRFC, a great one also. You have another one called the Mergers and Acquisitions Professional, right? This is really delivered by this designation is delivered by the issued by the Institute for Mergers, Acquisitions and Alliances. Now, a lot of these professionals, they work for investment bankers, for investment banks. They help in mergers and acquisition, but the most important thing here is that they are also very knowledgeable when it comes to investments. So give them a chance when they give you a pitch, when they make a pitch to you. We have a personal financial specialist. This is also a very respectable. This is actually one of the most respectable designations here because it is issued by a strong organization also, which is the American Institute of Certified American Institute of Certified Public Accountants. And then you have the Qualified Financial Planner, the QFP, which is the last one on the list here. Oh no, I have two more. This is also very, very interesting. This is a great one too. It is issued by the International Association of Qualified Financial Planners. This is a good one also, QFP. We have also a Chartered Senior Financial Planner, the CSFP. So Chartered Senior Financial Planner, and this is issued by the Association of Chartered Senior Financial Planners. This is a good one also. You can trust them. And you also have a chartered trust and estate planner, CTEP. This designation is issued by the Global Academy of Finance and Management, right? So this is another trustworthy designation. I actually have 4 more, but I believe that those are the ones that you can trust. Those are the ones that have proven to the market that they are trustworthy, they are relevant to today's economy, and they can really, you can give them a chance in terms of listening to what they have to say. Before I move on to the next section, I just want to quickly say 2 more. I want to quickly give you 2 more designations that I believe are important. I just sort of didn't see them before. I think they are very important. And the first one is Chartered Financial Consultant. That's CHFC. And this is issued by the American College. This designation is one of the oldest designations when it comes to investments, and it's very well respected. And you also have the Chartered Financial Analyst, CFA. CFA is literally a great, very solid, very solid designation. And this is issued by the CFA Institute. The good thing about CFA is that CFA is a globally recognized designation. Now, some of these designations here are only limited to the United States, but the CFA has this sort of international clout, international prestige. The same thing goes with the PFS, which is delivered by the American Institute of Certified Public Accountants, the AICPA. So you can trust those 2 institutions, or those 2 designations even more if you want to work overseas, or you are thinking about somebody comes to see you with that designation. If you're not an American citizen, you can still trust what they have to offer. So this is where you are now. Very important here before we move on to the next section. I'm not saying that these are the only designations you have to trust, right? Because I'm not endorsing anyone here. I'm not endorsing any designation here. I'm just reiterating the fact that when you choose a financial advisor, go for an advisor who has been certified by either the American National Standards Institute or the National Commission for Certifying Agencies, or another reputable private organizations, right? Those certifying bodies can allow you to check the advisor's designation online. You can read the complaint procedure, and you can even fill a form if they mess up with you in the future. And you can see also a list of disciplines designees, right? So it's important to see those people who have already been disciplined. You can see if the person talking to you is part of that list of discipline designees, right? So we'll be right back right after this. Welcome back, folks, to Sweaty Kiwi. We're still here talking about investment, beautiful stuff, a lot of good stuff. I want to quickly talk to you about, how to make real money, because we talked about again, this is the easy peasy complete investment guide for newbies and veterans alike. I told you what to trade, where to invest, when to take it easy and stay put, especially when it comes to fraud. I just finished talking to you about whom to trust. Now I want to talk to you about how to make real money. Now, this is very important because I'm here for a reason, and it is an interesting story. I want to share with you the science behind successful investing. It is a science. It is a methodical approach that has its own rules, codes, edicts, and principles. If you follow them directly, if you follow them correctly, consistently, and strictly, as do the top 1,327 most successful traders of all time, you too will become extremely successful and wealthy thanks to your investment, right? So now let's talk about how to make real money. I love this part of the show. How to make real money. How to make real money. Now, the first thing you want to do is you want to be a value investor. Let me repeat that. To make real money, you want to be a value investor. Now, what is value investing? Value investing is an investment paradigm that involves buying securities that appear underpriced. Right? So how do you determine whether or not this is a security, a stock or bond is underpriced? You have to do this through some form of fundamental analysis. Right? So what that means is that you purchase stocks, for instance, at a price of around 2/3 or less of their, what specialists called, their intrinsic value. Now, we have an entire show about intrinsic value and value investing. So here today, I'm not going to go too much in details about the terminology here, but I just want to give you a quick idea of what we're talking about here. So value investors want to risk as little capital as possible in potentially overvalued asset. So they try not to overpay for investment. They always try to underpay for investments. Now, the investing process itself, it's very, very, very methodical. Value investing uses bottom-up investing, right? I mean, there are two types of investing processes. There are two types of investment processes, right? You have something called top-down, and you have something called bottom-up. Now, a top-down approach to investing begins with analyzing the economy. So you analyze the economy, the broad market conditions, the interest rates, and other macroeconomic data, and then you decide which sector is expected to benefit, right? And then you pick the stocks from those sectors. That's top-down approach. You see? And let me just kind of repeat that so everybody is on the same page here. So top-down approach, you start with analyzing the economy and the broad market conditions, right? Look at the overall condition of the market and the economy. So the interest rate, and other macroeconomic data. I'm talking about, things like a GDP, that kind of stuff, trade balance, this sort of stuff. And you want to decide which sector is expected to benefit based on your analysis, and you buy stocks from those sectors. That's top down. On the other hand, you have something called bottom-up investing. In the bottom-up investing, you ignore completely general market conditions and macroeconomic data. Like, you really don't care about that. You don't care about what's happening. You focus only on stock selection based on the analysis of the company's fundamentals, right? So the fundamentals, this is why it's called fundamental analysis. So you focus on things like the company's business, the business model, their balance sheet, the valuation, this kind of stuff, right? So value investors always prefer bottom-up investment. They prefer a bottom-up investment approach. Like, they really don't care about whether everybody's just committed suicide in the whole world. They just focus on the company. like in 2008, where the whole global economy was crumbling, Warren Buffett, one of the top value investors, he was making money. He was not making money, but he was literally injecting cash in some companies that had solid fundamentals. So Warren Buffett didn't care about the overall economy. He was more focused on, is this company legit? Is this company solid? Yes. And he made tons of money. As a matter of fact, for instance, he loaned cash to Goldman Sachs, right? He loaned cash to Goldman Sachs at a very critical moment. And Warren Buffett, the genius, the investment genius he was able to make an ROI in 3 digits. 3 digits. That means more than 100%. So that's very important. That's what value investing is, bottom up. Now, value investors try to find undervalued stock, right? Now, I don't want to get too technical here because, but just know in general that you can find undervalued stocks by using a series of calculations. There are a whole area of tools to use to find, if a stock is undervalued. There are ratios called, for instance, you have price to earnings ratio, price to book ratio, debt to equity, free cash flows, price over earnings to growth ratios. Those are things that you can actually calculate. And today there are a lot of apps out there in Android or iOS phones. You can just download the apps and you just plug. All you have to do is just plug the company and the app gives you all the info. Now, I'm not really endorsing any app here, so I'm not giving names, but the most important thing is that you can just search in Google Play Store or Google, just look on your phone and cell phone. You can find financial apps that allow you to determine whether a stock is undervalued. So to make real money, you want to become a value investor. All right, we'll be right back right after this. Welcome back, folks. I'm still around here. I'm just enjoying this content here. I want to welcome you back to the show. In the last section, I was telling you to be a value investor to make real money. Now, I want you to think like a value investor. To make real money, you have to be a value investor, but you also have to think as a value investor. Now, here are some famous value investors. I think I told you before. I spoke to you about Warren Buffett, right? This is the quintessential. This is the ultimate value investor. He doesn't need any introduction, right? Buffett is considered to be one of the greatest investors of all time, and this is hands down. His investing strategy, value, and principles can be used to help investors make good investment decisions. So that's one really famous value investor. Another one is Michael Lee Chin. This guy, he's Canadian, and now Michael Lee Chin is today he is the chairman of Portland Holdings. It's a company that owns a diverse collection of businesses throughout the Caribbean and North America. But he's a Canadian. He's based in Canada. Now, his mantra is buy, hold, and prosper. Think about that. Michael Lee Chin's mantra is buy, hold, and prosper. So, and this motto has served him pretty well, because as of November 2019, his net worth was $2.8 billion, according to Forbes. Now, this guy was born in 1951 to a teenage mother in Jamaica, right? But now he is one of Canada's most prominent billionaires, right? So, and he entered, the financial sector at a very young age 26, with a job as a mutual fund salesperson. But so today, he's able to attain his status through shrewd investments. Now, the third person I want to introduce to you very briefly is one of my role models, a great guy, a great mind, David Abrams. Now, David Abrams is a hedge fund guru. He is the head of the Boston-based Abrams Capital Management. Right, this fund was founded in 1999. Now, Abrams, this is just fantastic. This is just brilliant here. Now, check this out. Abrams has been able to perform better than 97% of hedge fund managers by realizing an annualized net return of 19% for investors. That's 19%. 19%. Can you imagine how hard that is? It is. If you have 10,000 or 20,000 or 100,000, to realize 19%, that's already complicated. Now, this guy, Mr. Abrams, is able to do this by managing billions of dollars, right? So according to Hedge Fund Intelligence, this track record of 19% is almost unheard of for such a large fund. And what's even more beautiful and inspiration to some people like me is that Abrams' fund is unlevered. What that means is that he does not invest with borrowed leverage funds. He maintains a lot of cash on hand, and he only uses his own funds. He only uses the money of the organization, the hedge funds. And this is great. So here you have it. You have three famous value investors, how they are able to do it. They only apply the bottom up approach, right? They buy, hold, and prosper. They only choose securities they can understand. They're not involved in those sort of complicated, exotic or, derivatives strategies. No, they just stick to the basics, which is why I'm saying this complete investment guide is not only for newbies, but also for veterans, traders, veteran investment professionals alike. Now, how do value investors make real money, and how you too can? I'm going to give you 5 tips, 5 easy peasy tips that you can apply to make real money, real ka-ching. Number 1, they own a concentrated portfolio of high quality businesses. So if you want to buy some stocks on the market, there are some high quality businesses you can buy, companies that are profitable, that make money, they have been around for 100 years or 50 years. Those are the companies you have to go for. Number 2, they understand the businesses in their portfolio, right? Before you buy a company stock or bonds, make sure you understand the kind of businesses the company is involved in. Number 3, they use other people's money prudently to create their own wealth. So they use other people's money cautiously to create their own wealth. Now, unless you are in the asset management industry, chances are you are only trying to manage your own money, right? But the idea of having a prudential approach, a cautious approach, is very good. Number 4, they ensure that their businesses are in industries with strong long-term growth, right? So you want to make sure that you put your money in an industry that has a strong, long-term growth pattern. And the last thing here is that they hold their businesses for the long term. You want to always hold a business. If you buy a stock in a company, think about long term. Don't think about selling within 3 months or 4 months or 1 year. No, have a long-term approach. And we'll be right back right after this. Welcome back, folks, to another section of Sweetie Kiwi. I'm very happy to have you here. I'm doing fantastic. I'm doing wonderful. I hope you are doing wonderful and marvelous. I want to first acknowledge some of our viewers and listeners and audience members. We really appreciate your help and support and suggestions. That's very fantastic. I want to acknowledge Jamie Dawson in Burgess, Illinois. I want to acknowledge Jesse Hunter, Toledo, Illinois. And I want to acknowledge Poppy King in Lodge, Illinois. Thank you so much. We appreciate your feedback. We love you. We bless you and your respective families. Let's talk further about value investing, because again, I want to break it down even further. I want to make sure you understand how to make real money here. Now, if you want to be a good value investor, the first thing you want to do is adopt an owner mentality. You want to adopt an owner mentality. This is very important. So if you're an owner, chances are you're not going to sell a stock or bond that you bought. You're not going to sell it very quickly, right? If there is a first emergency, you're just going to sell it. It doesn't work that way if you have an owner mentality. You want to stick with long-term value investing strategies, right? So don't let fear, anger, or ignorance, or resentment, or stress, don't let greed change your investing criteria and values. Don't allow yourself to become overwhelmed by outside forces that affect your emotion, right? So the bottom line here is that if you are an owner, you will never sell into panic, right? You will always have a long-term vision, and this is what is needed here. Invest in what you understand. As I said earlier, Warren Buffett and the other great value investors, Michael Leachin and David Abrams, they only invest in companies they understand and believes have stable or predictable products for the next 10-15 years, right? This is one of the reasons why, for instance, Warren Buffett, he has typically avoided technology technological companies, right? He has never invested in IT companies. So, for him, I mean, I sort of disagree with him on that, because I believe technology is a great, field, but he has his philosophy. He's way better than me when it comes to investment, so I would trust his insights on that one. Another thing you want to do is you want to invest like you are buying the entire company. If you invest like you are buying the entire company, it really helps you spend more time on doing analysis and doing due diligence, right? You want to take a hard look at the enterprise value, because if you're thinking that you are buying the entire company, then you are thinking the money you're giving them is the total price of the company. So you would want to do more due diligence to make sure that you're not overpaying or underpaying for the company, right? One thing that you also want to look at is that you want to invest in companies that have competitive advantages, right? Companies that have pricing power, they have powerful brands, they have strategic assets, or other competitive advantages, especially those who are constantly, innovating, or those who are spending a lot of money in R&D. Those companies have the ability to outperform in good and challenging times. So you want to really have a good long-term investment strategies to identify and invest in those companies that can weather both good and bad economic times, right? So this is very important. Another thing that Warren Buffett believes in is finding quality companies. So this is the kind of companies where, again, are able to outperform their rivals in the long term, and he doesn't mind actually paying a fair price for the great company, rather than a low price for a mediocre company. So use the same strategy and try to find, profitable and great companies to invest in. One thing that I said earlier also is there are moments when you have to stay put and not do anything, right? So try to keep cash on hand if possible, because investment opportunities become available through broad market corrections or individual stocks that become bargains. So it's always important to keep dry powder on hand, right? So you can, for a value investor, dry powder, in other words, aka cash, is very important, because having the right dry powder can be the deal breaker or the deal maker in very tough times, because you can always invest when there are market corrections. One thing that is very important also is that you want to think about the value of compounding and patience, right? The value of patience is very important when it comes to being a value investor. So, you have to understand the power of exponential growth. So companies with sustainable profit can pay and grow their dividends, right? There are few more powerful long-term investing strategies than dividend growth compounding. So this is one of the reasons why in value investing, again, you don't care about the overall market economy at a particular at a particular time. What you care about is the fundamentals of the company itself, right? So this is basically just kind of wrap up today's show. This is basically what you have to think more about when it comes to value investing. We will be right back right after this. Welcome back, folks, to the last section of this show, and I wanted to say thank you for being around. I really want to say thanks to all our viewers again, all our beautiful audience members. We appreciate you being around. This has been a great show. We want to say thank you to Matthew Allen in Bangor, Indiana, Luke Roberts in Plainville, Indiana, and Kathy Thomas in Brownsburg, Indiana. In this show, this was a complete investment guide for newbies and veterans alike. And I talked about what to trade. I gave you factors to consider in selecting financial instruments. I gave you the top 5 financial instruments, which financial instruments to trade. In the second section, I talked about where to invest, things to consider before you invest. Investing in fixed income products, corporate bonds, investing in fixed income products, government bonds, investing in other products, equity, exotic products, and what you can do to avoid investment frauds. I also talked about investing overseas, right? And when it came to whom to trust, I talked about how to choose a financial professional. I talked about the designations that are important, and that's very important. I also talked about how to choose a reputable certified professional. That's always important to have someone who has a certification. And I also gave you a few other designations that you can trust, right? And then I moved on to how to make real money. And how to make real money, I talked to you a little bit about how to be a value investor. Why is it is important to be a value investor, right? I also gave you the example of very top-notch value investors to sort of give you an idea of how to excel like them, how to emulate them, right? And now I just want to give you the call to action. Today is all about growing your portfolio, becoming rich, becoming a rich person, moving forward in life. And I want to give you a few recommendations you can do to move forward, to become rich, to start making the changes that are needed for you to move forward. So, call to action. In every show, we like to give call to actions. We like our viewers to take actions, because actions is power. Actions is omnipotence. Action is overpower, is superpower. People talk about information is power. Information is not power, because having information and not acting on it is nothing, right? You have to be able to act on the information that you have received. So today I want you to start setting investment goals. Set investment goals. Now it's time to decide what you want to get out of investing. Invest early. The earlier you start investing, the better, right? Make your investments automatic. So have direct deposits, have the direct debits. So every month you have $10 or $50 that come out of your bank account and go into your brokerage account, your investment account. Look at your finances. Use a budgeting app to track your finances. Learn about investing, right? So hire an expert, a wealth manager, a private banker, or financial advisor. So you want to surround yourself with people who know more about investment, so you don't make the mistakes that others have made. And this is very important, right? So here you have it today. Thank you so much for listening to this show. I wish you incredible success in your career, in your investments, and I will see you next time. Oh, hold on. I still have to give you the pro tip of today. I'll be right back right after this. Welcome back. This is today's pro tip. Set up retirement accounts and be always wary of commissions when you have the retirement accounts. Diversify your investments. Study constantly your portfolio and always review the financial markets. This is it. Thank you. Be wealthy and be more on the way.